Hi, welcome to More Than Mortgages. This is episode 9, I think. Hopefully, I didn't screw that up. I'm Chad Anderson. Zach Jones coming up in just a matter of seconds. And today, we've been going through some different pieces and elements of the home buying process, real estate lawsuits, breaking down some of the math on some different things, talking about the memes you see online. And today, we want to do more math. January math 2024, everybody's favorite topic is math from school. And so it's so pertinent to what we do every single day. And a lot of times, again, you see surface level things on social media, but you don't actually see deep down what it may come out to be, whether it's good or bad. So we like to explain the numbers. And we like to take a deeper look for you and try to do a little education for you and for ourselves, to be quite frank. This exercise is good for Zach and I. So let's bring him in. How you doing, buddy?
Hey, I'm good, Chad. It's a good day. Had
It
a
is.
couple of clear to closes this week, and we've got a
Man,
little
nice.
weather here and got a little weather here in Tennessee. So I think we're delaying closing, but it's not. It's an act of God. It's not an act of modern lending.
No, it's still your fault, Zach. I don't know if you knew this.
Well,
It's still your fault. Okay, just ask. It'll be your fault. All right. So blended rate and savings and refinances and things like that. And I've done a video, Zach. We've talked about it briefly. It's a soapbox type moment and discussion for me, and that is your equity is great. You probably, if you're a homeowner, have more equity unless you just bought. You probably have more equity in your home right now than you've ever had in your entire life, and
Yep.
maybe more than you ever will, to be honest. But as we've discussed, there are only three ways to get equity, right? And that's take out a HELOC, which is right now a pretty high interest rate. I mean,
Right.
you're talking 8.5, 9, 9.5, 10, 11%, depending on credit and all these other factors. That's one. So you could do that. That's high interest rate. You could sell your home. Now, the problem is, where do you go? And interest rates are a little bit higher, but that's another way to get your equity. You also have to look at, are there any tax consequences? Like, are you beyond the exemption
Right.
that you get when you sell your primary home? Have you lived in your primary home 2 years to get that exemption? So that's another thing to consider. And then the last is a cash out refinance. And that's what we're going to talk about today, because with a blended rate, people get so locked in of, no, I can't cash out. I've got a 3% interest rate. I got to hold on to that thing. Like, you can hold on to it all you want, but at some point, in order to access your equity, you are giving up your 3% rate. And for those of you that say no because you get a HELOC, that's false right there, because the 9% HELOC factors into your household budget. So it's skewing your 3% rate, whether you like it or not.
Right.
So, um, yeah, this is one too where people kind of miss the forest for the trees. So we're going to talk about that too, with minimum payments on credit cards, high interest rates on credit cards, and maybe your budget's okay, but if it's based on the minimums, I mean, that's at least a couple of things. You got any other thoughts before we share screens here on, what
Well,
people maybe overlook sometimes?
Chad, I absolutely love this calculation because I think it really is a misunderstood and overlooked way to look at finances.
Hmm.
And it's like critically important financial basics to see and be able to calculate a blended rate calculation. I learned about this like in my first year in the mortgage business back in the early 2000s, a lot of refinances. And I thought, why didn't I ever learn this in school? Why is nobody teaching this? I went to school back when they actually had home economics, and they taught you how to balance a checkbook and
Home
how
ec,
to calculate
dice and
interest.
onions.
Yeah, man, it was, I mean, crazy time where they used to tell you how to manage money in school. That
Yeah.
was prior to the big boom in student loans, because I think those two might be counterintuitive. But to actually understand the way you calculate a blended rate and look at the whole big picture calculation of the interest that you're paying, incredibly important long-term basics. And then for
Yeah.
me, once I understood it, it kind of cut a groove in my brain, and I can't unsee it now. I see it in everything that we do around the house in terms of our personal finances. it's always about blended rate, and it's never about one single rate. It's how does that play into the whole.
Yep, exactly. And it's just math, guys. But here's the thing about math, and we deal with this too, is salespeople and humans and people who have different agendas can narrate and navigate and recreate math in ways that they want it to appear.
Right.
So at the end of the day, though, it is just math, and sometimes we just need to simplify it. So that's what
And
we're going to do.
the
Go
reason
ahead.
that people can navigate around that is because other people that they're talking to are scared of math. They just don't understand
True.
it, and they get overwhelmed or whatever. It's not that hard, and we're going to show you how simple it is.
All right, so let's pull this up. This is thanks to our good friends at MBS Highway. So we're gonna scroll through, and guys, this is real life situation here. Like this is made up, but at the same time, this is very, very similar to things we see every day. I can
Right.
personally tell you, I've seen obviously situations better than this where people are basically debt free. So yeah, keep your low rate. You're good to go. I've also seen situations where people are in 2 and 3 times worse position than what we're about to show you.
Right.
So just
But
bear
this
with
is
us.
kind of a good shot at a typical American middle to upper middle class family, and the
Exactly.
situation they're probably in right now, today, in early 2024.
And especially since COVID and people have had to go into
Right.
credit card debt, the economy has been struggling. People are getting multiple jobs. They're living off credit cards to survive a lot of times. So all these things play a factor. And that's why people get into these situations. And again, your equity can be your safety net, literally can save you from just spinning your wheels and spending too much money. All right. So let's assume here we owe $300,000 on a home that we bought, 4, 5, 6 years ago, whatever the case may be. Because again, if you just bought it in the last year, 2 years, well, I don't know that you're going to be able to cash out and refinance
Right.
unless you put a significant money or down payment on the property. Okay, because that obviously frees up some equity there. But if you got in at the minimum, your home probably is not appreciated enough to make this possible. So you have a house, 300 grand. We're going to go 3 1/8. That's the payment on a 30-year fixed. Again, principal and interest only here, but that's the payment. Um, Installment loan. Zach, you came up with this one. What's installment loans? What's possible here?
So this is, we're going to call this the pandemic installment loan. So everybody gets locked down. The house is too small. Maybe you're finishing out the attic space to give you an extra room, a craft room, a workout room, a bonus room. Maybe you're putting a pool in the backyard with a barbecue and some outdoor living space. Maybe you went and got yourself an RV because the RV craze went absolutely bonkers, or maybe you picked up a ski boat because it was back to family time and you wanted to make some memories in the middle of this deal, and you weren't able to. It's so easy to justify those changes during that pandemic period. So a lot of spending went on, but we spent $90,000 on something during that period of time. And now we've got an $1,128 payment. And what's that interest rate on that? 11%, Chad?
Yeah, we decided 11% is probably pretty fair on a 12-year repayment term.
Right.
So that puts you at $1,128 per month. And like Zach said, it could be COVID purchases, swimming pool, outdoor kitchen. It could be consolidation of other debt, the RV that you went camping in because you couldn't hang out with people during COVID. A lot of different variables. So we threw that one in. All right, now let's talk about car notes. So we've got a car loan, only 30 grand still owed on this one, 7.9% here. Now, some of you may argue, again, guys, this is all hypothetical. We're just showing you examples because I know somebody's watching going, well, I got 3.5 on my car. Like, okay, I got it. Maybe you did. But car notes have been pretty high over the last year and a half, 2 years. So they've been increasing just like everything. On this one, you had to get the new Range Rover, or that's actually a really cheap Range Rover. You had to get
That
the new
was the used
BMW.
one. That was the
You had to-
used one.
yeah, you had to get the new Mercedes or the BMW or something. The X5, man, had to grab it.
Right.
A little over 8%, payment 1055. Now the credit card sections, and watch this blended rate, okay, as we go. Southwest Chase Visa, especially if you live in Nashville, everybody has a Southwest Visa card. I feel like you get those air miles, the points, you get your free flights, the whole deal. But with Chase, interest rate about 25% on that. And so we came up doing a calculator of around 450 a month. Again, these could vary a little bit as well, but you get the example.
Let
If
me
you're
let
not
me
on
break
South,
in here real quick,
yeah,
Chad,
go ahead.
because I feel like maybe we missed a basic. So
Okay.
the blended rate that you're seeing here at the top of the screen, that is taking the overall
Thank you. Yeah.
balance and seeing how each specific individual rate and the percentage of the overall balance blends into this, and then averaging it out. So if your house was half of your debt, then that rate takes up 50% of the blended rate calculation. So that's why this thing is changing around a little bit. You'll see it climb as we go through these higher interest rate loans. Um, because what it's doing is it's taking an overall blended rate, an average based on the percentage of debt that you owe.
Yeah. Which piece of the pie? How much of the pie does the mortgage
Fine.
have? How
Yeah.
much of the pie does the Chase Visa have? Correct. And then it's tacking everything on and applying the percentage and the average. So perfect. Thank you for clearing that up. Because that is the point. That, and we're going to look at monthly payment too and how that breaks down. If you're not on Southwest, Zach, and you don't like flying general admission, as my dad says, then you fly Delta and you have an Amex and you get your Sky Miles.
Right.
And of course, that's at 12 grand. But Amex is a little more severe. They're up at 29% on their interest rates. Who doesn't have Amazon Prime? Who we all know,
Got to
you
have it.
or your kids, or you blame your kids. You've clicked the buy now in the cart, and all of a sudden you've got $3,500. Amazon, Jeff is no slouch here. He knows to grab 24% from you. We all have the new
After all,
laptop.
you're getting an extra 3% cash back on the right purchases, so it's
Yeah,
worth it,
that's right.
right?
That's right. Your Apple card. Everybody's got the new laptop, or you had to grab an iPad, or if you're like me and your kid broke his iPad, you go buy the new one. So break that down again. 24% with Apple. It actually may be higher, I think, but some of those will have a 12-month promotion too. So I get
Right.
it, 0%. But how many people actually get it paid off? Like, they're not making money on that, or they're not going broke on that promotion,
Right.
guys. Like,
Right.
there's enough
They're
people
making
not
money on
doing
it.
it.
Yeah.
Yes,
Yeah.
correct. You had to go to Target, Zach.
Got to have a Target card because that's 15% off when you open it up for that little red card, and then that's a good way to kind of sneak around on your Target purchases. And not that anybody would do that, but
Would never happen, Zach, ever.
I'm talking about the typical Americans. I'm not talking about anything that happens at my house.
It- Amazon Prime, I think our address pops up automatically as the delivery guy's home address. Like, he's just
Yeah,
so used to, hitting the
yeah,
cul-de-sac
yeah,
every
yeah.
day, man. Student loans, we'll say 7% is probably a pretty good average, right? Now, here's the ironic part, because I got to tell everybody this, okay? Is that Zach and I did a quick dress rehearsal on this before we started recording. And we ran through this, and then we realized, the blended rate's already showing at the top, and it's not as much fun, or doesn't get the point across, whatever. Well, so we said, okay, we'll leave all the payments. We memorized the interest rates, and we hit the rates as we just went through. And what's funny is Zach goes, "What's a cash out refinance rate these days?" And we'd think about it and look it up real quick. What did we say, Zach?
6.9%.
6 point.
Which is
I swear, true story.
crazy that we landed on this number here, right?
So I swear it's not a setup. This wasn't Hollywood scripted.
Crazy.
That's completely by chance. So here's our point: is it's 6.9%. That is your current blended rate. So don't think of only your rate on your house. This is your rate for your budget. This is your family's interest rate. This is what you guys pay every single month. 6.9%. You pay
It's everything but
6.9%.
your utilities.
Yeah.
Everything but your utilities.
Yeah, correct. So, and there are other things in here, as far as like just miscellaneous debt, like utilities, Zach mentioned, internet, cell phone, some groceries, things of that sort. So you still got other debt, that you're paying, but things on your credit, things that you applied to get credit for, you're paying 6.9% overall. So you may go, well, I got 3.1 right here. But these others are to the point that you actually have 6.9. Now, okay, let's take it a step further. All these right here are all minimum payments. Minimum payments. So if you take a look, Zach, drum roll, tell us that's the total payments going out right now.
Well,
Zach, what are the
let me hit you with the minimum payment idea, and
Yep.
because I don't know that a lot of people even really pay attention to this, but minimum payments often, especially on credit cards and student loans, are not actually servicing the debt. They're not paying your interest in full. They're just a minimum payment. So you're in a negative amortization situation where your balance climbs every month, even though you're not borrowing more
It
and you're
can, yeah.
paying your payment.
Yeah,
So
it can.
you're not, and that's the situation in a lot of especially credit card situations. So
Yeah.
drum roll, please. If we came in and did a cash out refinance, utilize the equity in your house on this same thing, put this same balance in at a 6.9% rate on a 30-year fixed term, then you're at 3650 a month for your
Wow.
minimum payment. Doesn't include taxes and insurance. It's $1,600 a month difference
But to
to
be
do the
fair,
cash out refinance.
this doesn't include taxes and insurance either. So it is
Right,
a
right.
true $1,600 reduction in payment. Okay,
And
1,600.
the debt is paying down.
Yeah.
The debt
Yeah.
is paying down. So if we didn't do this math, Chad, but if you wanted to get crazy about it and you were trying to pay your debt off by the time you retired, and you were going to be on a fixed income, what
Yeah.
would $1,600 a month extra on the mortgage that you just did a cash out refinance on, how quickly would that pay off?
Yeah, I don't have that calculator in front of me.
Man, that
But
would be a good one. That would be a
yeah,
good one.
it would. I mean, if your payment is 3,600 and you're paying 1,600, you know what? Let's leave everybody in suspense for a quick second. Let's just see real quick. I'm going to take one shot at it. And if you just kept paying it, kept paying it, you'd pay it off in about 12 and a half years.
12 and a half years.
Yeah, that's
Now,
rough math, but that's doing a quick calculator, but that's about right.
even if it's 15. So here's one of my favorite little strategies where we're looking at unpredictable economy. That's being nice. Is I love the 30-year term. Even if you're planning on paying it off quicker, you've
Yes.
got the flexibility of bouncing back on that 30-year payment if you need it for a couple of months, or you have an unexpected expense, or you need to replace the HVAC system or something like that, and then bouncing back in and going after it. So this situation could be an awesome deal for somebody who is 50 years old and trying to get out of debt by the time they were 62 and a half.
Yeah.
You're completely out of debt for the same payment that you would be making on all of these notes, and you'd still be left with debt in 12 and a half years. You could be completely debt free at the point where you go into a fixed income situation, or you've got 4 kids going into college, or there's lots of kind of those timeline horizons for people to be trying to look at really freeing up their income because they've got other expenses coming aboard, or their income's going to go down dramatically.
Yeah, and to piggyback on what Zach just said there with the 30 and the 15, that's going to become a bigger and bigger topic as we see rates drop and we see more people doing refinances. Here's another great thing, Zach or myself, if you ever decide to reach out to one of us for an analysis or looking at your situation, we both have this option where we can do what's called a flex term.
Right.
So what that means is if you're 3 years into a mortgage or 5 years into a mortgage and you say, well, wait a minute, I don't want to go back to a 30. we can actually refinance you to the exact year that's left on your current mortgage. So you don't have to go backwards to the 30 year.
Right.
You can continue with what you have if you'd like. That just makes the amortization schedule a little bit more aggressive in your favor. However, the one thing, and to the other point with Zach, is I always do the same thing. I recommend the 30 year and you pay extra. The reason is the 30 year is going to get you the lowest payment. The benefit of generally taking a shorter term is a lower interest rate. On average, what's a 15 year? Point and a quarter, maybe a point and a half better than a 30 year sometimes. Just you could say anywhere from 3/4 of a point to 1.5. And that's a little bit of a broad range, but we can just go with that for now. So you're by doing a 30 year, that's your sacrifice. 3/4 to 1.5% on the interest rate. However, let's say you do the 15 year. Life happens and you can't make that payment or it puts you in a bind. The mortgage company does not just automatically let you default back to a 30. You have to refinance again. And you
Right.
have to then refinance at the current market rate, which could be higher than what you have. You also have to refinance. Well, when you do the current market, you have to qualify again. So if you can't make the payment because, God forbid, somebody lost a job or somebody passed away who was the breadwinner, you can't go backwards because you still have to qualify. You still have to have high enough credit, still have to have enough income, still have to meet the debt requirements and so forth. So that's why, and I 100% agree with what you said, Zach. Start at the 30 and then pay it down to the 15.
Yeah.
Yeah. So, um, any
This
final
turned
thoughts
out to
on this?
be, Chad, this turned out to be a great example because it's literally, you're talking about a cash out refinance where a typical American might be concerned about giving up their 3% rate on their mortgage, but for the same amount of outlay, they could solve all of that debt in 12 and a half years.
Correct.
It's really an incredible example, and I don't we didn't start out with that target in mind, but it turned out to be a great example.
The biggest thing I want everyone to take away from this episode and this show today is that no matter what this says right here, okay, that's not your interest rate. Your interest rate is this or whatever it is in your situation. Okay. That's our point today, is that everybody gets so hung up on what rate they have and what they've done. And that's great. But again, this is your true interest rate right here. This is what you're paying back every single month. Just this piece of the pie, as we discussed earlier, happens to be a very low and attractive rate in today's market. And I still revert back to, remember, only 3 ways to get your equity. That's it. There's 3 ways to get equity: HELOC, sell your home, or cash out refi. Otherwise, your equity is just it's just a figment of your imagination, right? Like it's just out there, but you can't touch it, you can't spend it. There's 3
Right.
ways to get it, and that's the end result. So, final thought?
It's good math. It's good math, and I hope that our listeners are what I said earlier. It cuts a groove in your brain to start thinking about
Yeah.
the way that interest rates work in your overall budget. And man, I love the analogy of the pie. What does your pie look like?
Yeah.
And that's the real question. And then how you've got to align yourself with a good financial expert who can kind of help you determine whether or not that's a cash out refinance, debt consolidation, and maybe only part of the debt too. I mean, some of
Yeah.
it might not fit into that. Some of it may need to fit into it. It's interesting to evaluate that as a big picture kind of a puzzle.
Yeah, great point. Don't assume it's an all or nothing shot. If you could get half of it paid off, that's great. And Zach or I will help you figure out which ones to tackle first. But yeah, don't think it's I don't have enough equity, I can't get everything. You
Right.
should still have us run the analysis and see what happens. Depending on your specific situation. So,
I'm gonna put one little exclamation point on the end of this.
okay,
We've referenced it in another one of our podcasts. There's kind of a variation on this to look at if you're selling a house and you're getting a bunch of equity out, about maybe some of this debt that you could pay down and make a lower down payment on the new house
Yeah.
That's another way to look at a blended rate calculation and really kind of take advantage of the long term. This idea that you've got to take all of your equity out of the house and put it into the new house and make the biggest down payment possible is not sound math. It
Not at
can
all.
be, but the making a rule out of that is not. It's just not good math. So again, it's taking a look at the whole picture, what you're
Yeah.
paying off, what you could pay off, and then how does that provide an advantage to you?
Yeah. I'm actually working with someone right now. We're doing that exact thing
Yeah.
because when they buy the new home, they're saving $3,300 a month on their
It, it,
budget
it
because we're
feels like
wiping
there's
everything
always
out.
right. It feels like there's always somebody in my pipeline where I'm like, okay, hey, but wait a minute. Let's take 40 of that. Why don't you just take 40 of that and knock all this stuff out?
Right.
Oh my gosh. Well, yeah. And they can't, it's almost like oftentimes people can't even wrap their mind around that. They're still kind of stuck on the payment's too high. It's like, no, you just alleviated $1,875 worth of debt. Oh yeah, that's like another house payment. So it takes some getting used to, but you've got to look at all those options because people just don't think about it. It doesn't occur.
Yep, that's right. Last thing, and not going to get off on this topic. You can go watch one of my videos if you want the explanation of it. PMI is the cheapest money in the entire market right now, and it should be your best friend, and it shouldn't be something you dodge. You
Yeah.
actually are a little bit of a fool if you don't leverage PMI because of how cheap that actually is. So I'm going to leave that there because it's
Well,
fascinating.
let me say this too.
Go
I've
ahead.
run into two different examples on social media in the last 2 days where
Hmm.
people were talking about PMI of $275 a month on 350 and $400,000 loan scenarios.
Yeah.
And I'm like, what in the world? Who are you talking to? Because I priced that out with excellent credit, 63 bucks a month.
Yeah.
And even FHA is not that high on a $400,000 loan. So I don't even understand what world that's coming from. Maybe it was an old FHA number. You've got to take a look at these details when you're making a decision about a mortgage loan because it's literally there's so many misunderstandings and myths about this. Again, you weren't going to get off on that, but I hit that hit my hot button. These two
Oh, it
examples
is.
just
It
recently.
it's a trigger point because the example I showed is similar to what you just said. And the other day I showed someone how PMI is costing them 1.2% annually. That's
Yeah.
it. 1.2% annually.
Yeah.
And we're freaking out about it. Nope.
Yeah.
PMI is one of the greatest things ever when it comes to real estate and mortgages. So, all right. You can catch him at Zach Jones Loans. Myself at This Chad Is Real. Best thing you can do to help us out, like, subscribe, follow, hit the bell, visit all of our platforms. They're in the top left corner right here. And make sure you comment, reach out, DM, engage. We love to answer questions too. So
Yeah.
if you've got a scenario, you can do it privately. It doesn't have to be in the comment section. But we appreciate everybody hanging out, the feedback we have gotten. Truly thankful for all of you. Have a great rest of your day. Try to stay warm. We're going to go build igloos, and we'll talk to you next week.
See ya.